Today, what we can learn from the UK. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And today, I've got a special guest, Joseph Wilks. Hello, Joseph.
Hello, Martin. Nice to meet you.
Great to see you here. Thank you very much for coming down on the train this morning and spending some time in the studio. You've got a really interesting history because you were there in the UK, in the real estate sector, in 2008 and beyond. So we can get a bit of a sense of what happened and what perhaps may look as though it could be happening here.
There's lots of similarities from the time I've spent over in Australia and New Zealand over the last few months. So yes, it is all panning out as if there could be a very similar event occur.
So let's go back. Let's just paint a bit of a picture of, you're in the UK, it's 2008. What are you seeing?
Yeah, well, I suppose a bit of background on me first of all.
Yep.
I was a director of a UK-based residential property company. We had 4 offices who were operating around the Hertfordshire region, which in essence is a market that's very susceptible to whatever happens in London, whatever happens in the financial markets. We would always see any London event hit us within a month. And as a result, you sort of build up a picture of patterns that occur when you get various financial crises. I started with a company in 2001 as a salesperson, and we saw the growth of the credit boom all the way through up to 2008, and then the aftermath and things that the government, the regulators, and everybody else had to deal with in the post-crisis event.
And we know that there was a very significant amount of credit driving the market.
Enormous.
And we know that prices went very, very high. Lending standards were pretty loose.
Very much so, yeah. And I think that from what we saw in the build-up to 2008 was Greenspan, after the dot-com bubble, lowered interest rates. That happened worldwide, and we saw a very sharp rise in the market from 2001. Really through to 2004, and it was quite interesting. 2004, Bank of England seemed to want to calm things down. It was interest rate policy rather than any specific look at how much credit was being lent. And for a brief period, they did calm things down, raising interest rates from 2004 for a year or so. 2005, it seems to have done its job. We had a market that had gone up 2001, 2004. It dropped off a little bit, probably sort of 10% correction in our area, and that provided a new base for, I guess, the growth in the market again. Interest rates were fairly steady then from 2004 to 2007-8, but what we were seeing, and from a frontline perspective, what we saw was when we were interviewing people who were buying houses, where many of them had gone and borrowed, in the earlier periods, 2000, 2001, 2002, people were borrowing 4 times, 5 times income. Very quickly from 2005 through to 2008, we were seeing people borrowing 5 times income, 6 times multiples of household income. And then in the latter stages, 2006, 2007, there was a lot of people who were being written 100% interest-only mortgages, which at the time seemed wonderful because from a salesman's perspective, we were able to carry on selling properties. From a market perspective, it created a headache, which really has affected volumes ever since 2008 in terms of people's mobility, their lifestyles, and just the opportunities they have to trade, all of which have evaporated from the market since.
And it's worth saying, I think, that the politicians in the UK in the sort of the 2005-2006 period were lauding the growth in the economy, the miracle that was actually happening there. We've seen the end of cycles. All of those things were there, weren't they?
Yeah, I mean it's no different. I think everybody likes to have everybody likes to be the good guy. I think politicians are no different. You're in politics generally because you want to be popular. You think you can make a difference, but quite often people don't actually understand the workings and the backgrounds that are going on behind this. And what we know now is that the neglect of the regulators and politicians with the regulators over the banks led to the crisis that has really hamstrung the UK UK for the last 10 years. It's quite interesting now coming down to the southern hemisphere. I've been living in the UK throughout this period, but moved to the southern hemisphere in 2017. Getting here and seeing exactly the same thing. In New Zealand, we've had a government, national government led by John Key and more recently Bill English, who have been wizards within the economy. There's been a period of growth that has been quite remarkable when you look at what's happened around the world, but in reality the credit cycle has grown. I've talked about comparisons in other posts that I've made around Australasia about how Tony Blair walked away from a car crash and handed the reins over to Gordon Brown, and it's very similar what we've seen in New Zealand in particular.
So just going back to the UK for a second, right? So we had Northern Rock, which was the first signs of cracks, and then we had more issues, and then we had the Royal Bank of Scotland and all of those things, the rescue packages, the effectively mad panic across the finance sector, and suddenly the real estate sector started to turn significantly bearish and quite quickly, didn't it?
Yeah, it was interesting. We were quite forward thinking. We as a business during 2007, we could see that people were starting to question the amount of money they were having to borrow to get into the market. Initially, it generally precipitates with a fall off completely in the lower end purchases. And what people fail to think about is that unless there is that cash injection from someone who's not committed to the market, the marginal buyer, either a step lower or at the higher end of the market, there isn't the facility for other people to move. One transaction in the UK, of a house, £300,000 flat, could actually provide the cash injection for 5, 6, 7, 8 other transactions. So without that, and that's really what we saw at the end of 2007 when Northern Rock started to present itself to the market. It was the first time buyers found it difficult to access credit, and as a result we saw sales drop off throughout the whole market, and volumes where we sort of analyse the volume of sales that we do every month, and throughout the year you always get a little bit of seasonality around Christmas and around the summer holidays, but you could put a 12-month rolling average on them, and we saw volumes drop off by between 30 and 40% in that second half of 2007, which was I suppose a precursor for what was going to happen next. What happened in 2007 in my local market was that many prices corrected quite quickly. People who wanted to move recognised that things were different. We were educating them, and they took prices and made their moves. And by the end of 2007, the market had probably corrected 10% from its earlier peak. What we also had at that point was, I guess, a Christmas period where people questioned, do I want to sell for less money? No, I don't want to sell for less money, so I'll take my house off the market. And what that meant in early 2008 was that we entered the market with very, very little stock, but with banks still quite happy to go and lend. The bonus season that affects the London market and its periphery at the end of 2008 had been very good. The banks had actually performed very well. They were still posting record profits 6 months before the crash. And that money filtered into Hertfordshire market, where people were quite keen to trade up, trade down, and spend the profits that they'd earned working for these banks. By March 2008, the market had actually recovered that 10% that it had lost in the second half of 2007. And I remember thinking at the end of March, well, look, we're running out of stock to sell because everything is selling. We can't put them on fast enough. And we had a series of open home events where we had multiple bids, 14, 15 offers on houses in the final 2 weeks of March, which again just pointed to this is starting to look a little bit unsustainable again. Bear Stearns for me, and we haven't had an event like that here yet. I say yet because I genuinely believe that it's going to happen. But Bear Stearns was the catalyst for a major change in sentiment within the market. The UK is quite different in terms of property system. You agree a price, you've often then got 6 to 8 weeks of legal work before you exchange contracts on the on the transaction, and then it's often another couple of weeks after that before you have the completion of the sale. So that 6-8 week period can create some heart flutters when buyers who have committed to an agreed price look at the market and say, well, hang on a minute, I've just seen a 5-bedroom house come on the market at the same price that I've agreed to pay for this 4-bedroom house. And what you find is that the loyalty within transactions just disappears, so things fall through. I had a sales book at the end of March 2008, which was 50% smaller within 3 weeks of 2008, and it was immediately a case of going and educating the market about, okay, situation's different, buyers aren't there. They were finding it very difficult to access credit. Not that the lending criteria changed massively, it's just the banks were only lending to the very best prospects. We've seen, I think, a bit of that happening over the last 12 months, and particularly since the Royal Commission over here. When we got to the summer period, June, July of 2008, sales books was really, really struggling. We'd seen property prices probably correct already by 10 to 15%. The upper end of the market had been particularly heavily affected, where previously people were quite happy to go and borrow 6, 7, 8, 900,000 pounds. The banks were really trimming back on what they'd offer the upper end market, and I suppose confidence was really waning. Then Lehman Brothers happened. Different type of event. The credit derivatives market, obviously very different to a normal lending environment where one bank has issues. This was obviously collateralized debt obligations being sent and sold around the world. But these credit issues can come off anything. And if I look back over the period since the credit crisis, 2012, the UK benefited when an enormous amount of Greek money hit the London property market and filtered its way as people cashed up on the central London sales, and I suppose what you call, and what the Americans called in the late 80s, white flight occurs, where people move to other areas where they feel that they've got space and they've got a bit of air, I suppose an environment that maybe they consider as comparable to what they had growing up themselves. That boosted prices, and around the country, there's that cash injection helped to facilitate the market move.
So we get through 2008, it all goes a bit pear-shaped, right? And prices then really start dropping, and quite significantly. And you said that the top end sort of started to move, but that presumably filtered down then across the market, didn't it?
Yeah, I mean, I think it was very different around the country. I mean, if you talk to people today who are in real estate in the UK and they're working in London, they'll say the prices are falling again. There'll be places in the UK that will say, well, prices are on the up again. But actually, they may, in many instances, if you go up to large parts of the north of England, prices have never got back to where they were in 2007, 2008. I know a lot of agents who, dare I say, the stock of available property that they have to sell is massively reduced, because we've now got a lending environment where if you don't have 25% equity to trade, and that's often got to come from your house or your current house, they won't lend you the money to go and trade on to the next house. So those that are bought with 100% mortgages, 125% mortgages, even more astonishingly, they are actually trapped. Life's trapped. They're limited to what the job prospects are. Quite often rents in their markets don't cover the mortgages that they've taken on board. And as a result, their, I suppose, flexibility for moving home, bringing up a family, having kids, changing addresses for work and career options, they're just massively stymied by their property.
So there's still households today that still living in negative equity, still struggling with that mountain of debt that they took, some years ago.
Yes.
And no way out.
Sadly so.
Yeah.
I don't think we suffered in the UK, in England, quite as much as they did in Ireland. Ireland seems to be going on another credit expansion at the moment, which we'll see how wise that will be in due course. But the challenges that we've faced was that the banks had lent so much money, and the marketplace today, earnings really have flatlined across the UK. Importing inflation on products has affected household disposable income. So while wages have gone up, they haven't gone up to anywhere near the extent that we've seen prices go up. And the debt servicing is now being massively rationed by the banks. We're now in an environment where if you'd be very, very hard pressed to borrow more than 4.5 times household income. And that would only happen if you had a 40% equity offering to give to the banks as a security. The redemption penalties that arrived on mortgages in the early 2000s are now incredibly penal. So if you want to move, the chances are that you're going to be looking at if it's within your fixed term of a mortgage, say fix your mortgage for 3 years, if you wanted to move or life changed direction and you wanted to move in year one, it's quite likely to be paying a 3% redemption penalty to the bank. And what that does is it just slows down the number of people that are in the market trying to sell and trying to move, and as a result has put a cushion on the price floor. So we've been wobbling around now in the UK in a price range which has really been 5% up, 10% down since 2013. So we've had 5 years where things have just wobbled around. Some of it's seasonal. You can't say any individual pocket of the market is performing well. Sometimes you'll have nothing selling for 12 months at the top end.
So what about the investor, or buy-to-let as it's called in the UK? Because I think that was a pretty significant factor in the run-up and the growth. And I suspect that recent legislative changes in the UK has really tightened that, hasn't it?
Yeah, well, a lot of those have come in the last 3 years. There've been influences. We had a change in, I guess, the foreign buying investor 3 years ago, 3.5 years ago now, where they were. So every purchase is subject to stamp duty at varying rates, but they're also subject to an additional 12% for foreign direct investment. The buy-to-let purchaser disappeared. They haven't been involved in the market really for 4 or 5 years. The yields don't. The average human being on the street in the UK doesn't earn enough money to pay the rent that a landlord would need to get to service the debt that he'd have to take on board to fund the mortgage. So we've not really seen investors for the last few years. What they appear to be doing in the UK is slowly encouraging investors to sell properties into the marketplace, and they're doing that by introducing the tapering of tax reliefs over the next 2 or 3 years, which I think will make most investments just untenable. They won't work without the tax breaks. So buy-to-let investor, very heavily involved in the market in 2007. We did see a spike of buy-to-let investment in 2016. I don't know how you describe it. The last turkeys into the field before the Christmas shoot, but they and it was quite bizarre because we were operating, and the government announced in November 2015 that they were going to introduce a 3% surcharge on top of the stamp duty rates for anyone who's buying a second property, and that's a second property as a holiday home or investment. And there was this massive rush from November 2015 through to November 2016. The bottom end of the market actually had been looking quite shaky in 2015 because there weren't any investors and there weren't any first-time buyers. But those who may have planned that for a 4 or 5 year period in advance, they took that moment to buy and inflated the market for 2-bedroom flats, went up from 250 grand to 325 grand in our local market. 1 bedrooms went from 250 to close to 300. And then the deadline hit on April the 4th and the buy-to-let investors were gone. And they've not really been seen since 2016. There's no reason to.
And it's worth saying, isn't it, that I think at the peak about 18% of lending was for investors. Give or take, right?
Yeah, I'd say give or take.
Yeah. In Australia, 35, 36, 37%.
And I think for me as well is the investors had an impact on the UK market, but it hasn't been anywhere near as prevalent as it has been here.
No.
We didn't have in the UK ever the ability for a first-time buyer to try and compete with equity from somebody's family home and leverage themselves up to 8, 9. And I've heard in instances where people have been borrowing 10 times household income on interest only.
10 to 12 is what I see in my surveys.
Yeah. We never got anywhere near that.
Yeah.
The biggest mortgages that I've heard people being issued were 6 and 7 times interest only. And I look back at where our rates were when that was happening. You could borrow money at sort of around 3.5% to 5%. In Australasia, they seem to have been doing it when the rates were up at 6 or 7, and we're only seeing a little cushion because the rates have come down. But obviously in Australia, they're back on the rise again.
Yeah.
I'm intrigued at the moment. I think that in New Zealand, with Reserve Bank rates stuck at 1.75%, but the main 4 players, who are the same 4 players that you've got here, bringing rates down now and being very competitive around 4% on mortgage rates. I think ANZ on Friday dropped their 1 year offering below 4%. That sparks to me of a marketplace that is desperately trying to sell credit because they are aware that either they've got investors who are going to struggle, or that they also need to sell new debt, which any functioning business needs to carry on its forward order book, as you were.
So you've brought in New Zealand to the table. Let's just talk about New Zealand for a little bit, because we have quite a few viewers on the YouTube channel from New Zealand, and they keep saying, why don't you talk more about New Zealand? Well, here's an opportunity, right? So you've had the opportunity to look at the New Zealand end of things.
I've spent a lot of time looking at the New Zealand market.
And I suspect that some of the things that we're seeing, in Australia, we're seeing overborrowing, we're seeing highly leveraged households, we're seeing the market starting to wobble.
Yeah.
Is that the same as in New Zealand, or is it more so, or how would you see it?
I think the one thing I would say about New Zealand is at the moment there is nobody shedding a light on it within the mainstream media. The difference here is that there are now articles being published on mainstream media, so you're involved in them, which are just pointing a light and shining a torch on, okay, well, this is a possible risk. In New Zealand, that's not happening. What I've seen in New Zealand is a press and a media which are very, very much driven by the banking industry. And my concerns over that are just the fear that when the creators of money are responsible for the media, that there is an influence. The real estate industry are also very, very heavily engaged in the sponsorship of the media, and I don't have any issue with that. I'm a property consultant first, and when you're trying to help people move home, then you do promote and you want to do that. But what I don't think there is really an understanding of the risks that there are within the system now. The mainstream media and the current government got elected in on there is a housing crisis, and the housing crisis is quite severe. It depends on how you want to phrase housing crisis. From what I can gather, the mainstream media are very much geared on an inability for young people to get into homes. Average age of first-time ownership is going up. I mean, I'm not sure what it is in New Zealand. I know it's near 40 in the UK, but it's got to be very similar to that or approaching that in New Zealand. And the homelessness side of things, which is a consequence of landlords, in my view, in Australia and New Zealand, taking on so much debt that they have to have high rents to service it, and even with the negative gearing allowances, they've taken on so much debt that it leaves a lot of the market out. Now, normally what you see is a concentration of tenants within a property, and we're seeing that in New Zealand. And from my perspective, I came from the UK where we used to speak to people who had in 2002, 2003 bought their first home in London, West Hampstead, say, and a 2-bedroom apartment in a block of 12 other apartments. And when they bought that in 2002, there'd probably been 50-50 split of owner-occupiers and landlords, and where generally the tenants were, what do you call, conventional. If there was a 2-bedroom house, there'd be 2 people living in it. Now, as we went through this in the UK, we saw that the concentration of tenants increased dramatically. Landlords in the boom 2002, 2007 took on more properties, more debt as well. And the only way they could service that was by having 2-bedroom properties that were occupied by 4 people, 5 people, 6 people, to cover the rent. And governments in the Western world where we've had these debt issues have, in my view, encouraged the increases in population to maintain the debt accumulation. Has it made it easier driving around Sydney or Auckland? No, because you've got more bodies in a limited space. But it's the narrative that's been used to go and push this housing credit crisis. Now, when you actually look around New Zealand, there is it's a wonderful country. There is and has been a housing boom, in my view. There's been an awful lot of debt, speculative debt, taken on by households, often the baby boomers going into retirement. I'll buy a plot, I'll build a house, I'll sell it into the market, I'll make another couple of $100,000 profit for my retirement. And more worryingly, I think, and it's really been unregulated over the last several years, 7 or 8 years, has been the explosion in foreign direct investment. And again, I don't think it's all corporate led. If it was corporate led, if it was government led, or if it was led by somebody who was controlling the infrastructure of an area and what was being built where and how it was being built. But there are, I would say, thousands of houses that are sitting empty around Auckland, which have been built over the last few years. The prices that are being asked for them now are astronomical, but they've been done because the speculative purchase of the land was too high, and in a crunch, normally it's land that goes first. I've seen land prices fall 50% over a 12-month period in the past. It happened in 2007, it happened again in 2012. Couldn't give land away. But a lot of mum and dads don't know these things, so they have got involved in this credit-driven speculation. And I think that they're doing it because they're being told by the mainstream media that there is a housing shortage and there's a genuine need for more properties. But we've got sites around Auckland now which are that they will be New Zealand's first shanty towns, in my opinion. They're built very, very cheaply. The builders, I think, are probably flown in from around the world to construct these projects over a year or 2 year period. Will they be there to fix issues when these houses have been, when they're 3 years old and something goes wrong with the plumbing? A good builder will have a guarantee. They'll be backed. They'll have accreditation. And you'll be able to go back. In the UK, we have an NHBC certificate, which means your builders are responsible, have to carry insurance, and you can go back to them for 10 years for any major faults. I can't see that happening on a lot of houses that are being built in New Zealand over the last few years. I saw a really interesting post that you and John did fairly recently on and John's frustration about the name
Block.
of it, the Block.
Yep.
And a similar show operates in New Zealand, and I took a visit to Auckland a couple of weekends ago, and saw the site where the Block had been filmed. It's a wonderful looking development, very much on a UK style, where we're building houses going up to the 3rd floor, and there's no parking, and everybody's going to have to park on the street if they ever have a teenager at home driving. But I'll warn you about that later. That's bad policy direction, which really, in a country like New Zealand, you shouldn't have to worry about. If you drive around, there are hundreds of these houses that are sitting empty. The development's gone up very quickly last couple of years, and there are houses that are already returning to the market. I went to view one, which was bought for 1.25 million in 2016. It's back on the market with a landlord who I don't even know what they were playing at, but they were on a purchase price of 1.25 million, had been getting $750 a week on a rent. For anyone wanting to think about that, you'd need $1,300, $1,400 a week to cover a 1.25 million debt over 25 years. So they're funding it, possibly with a bit of negative gearing and possibly with a bit of topping up. And the agent was quite happy to tell me that they would be delighted to take 1.1 million. So, already accepting that they will take a loss. And my guess is that they've probably been taking a weekly loss ever since they bought this thing. So the hype is enormous. It's sponsored by the banks. I think the real estate industry are struggling to know how to deal with it. And that's where I'm consulting firms now to help them understand the way that they need to react to this marketplace. There probably has to be an acceptance in Australia and New Zealand that there will be some houses over the next few years that they won't be sold unless circumstances dictate that the bank sells them. And that's it's not a nice position to be in, but that will be the reality. There will be many who will get stuck, like those people that we talked about earlier in the UK. That's tough times for those that do find their options and opportunities in life restricted because of some fairly lax regulation of banking.
And it's interesting that you've talked about regulation and the banks, and because effectively I think that's the missing piece of the puzzle that people often don't understand, right? This isn't a market that just happened. It was actually almost intentional, right? Because effectively it was using credit, and it was using the housing sector, and it was using household consumption to drive the economic engine.
It's a confession from me, Martin. I studied economics at university and had no idea that the banks create money, and that the powers that we thought that are with the Reserve Bank to control the money supply. And what we're always told is that savings go into a bank and they come out the other end as 5 people offering money to a bank for savings. They get a little percentage, and then that bank lends a mortgage. I only discovered that wasn't the case. When looking at how tough things were for us in the UK and how we're going to stimulate growth in the market, and why can't we find more people who want to sell their houses, and actually realising that half our marketplace is trapped. It could be quite demoralising if you looked at it from a business perspective, and you think, well, do you know what, we're probably at our maximum growth point. I worked in a company where we were very fortunate. We grew our share of a shrinking pie, so that we ended up, from having maybe 13 or 14% of a big pie, we had close to 50% of a very small pie, across a marketplace where we were very, very dominant. That's what I think we're going to see come over here. I think that there will be a lot of estate agents in Australasia who will struggle to deal with it, to communicate it.
And so we are effectively mirroring the UK pre-2007. Is without wanting to put words in your mouth, there would seem to be some parallels.
It's very, very similar, except to the extent that I would almost say that we've allowed it to go on beyond 2004. In Australasia, so we probably had another 2 or 3 years worth of stupidity, and I use that term, I say loosely, but we've had another 2 or 3 years where things have been hyped up. This always go up mentality. People have almost forgotten that actually a lot of the market flatlined, even in the southern hemisphere, flatlined for 2 or 3 years after the crisis. There were quite a lot of areas where prices fell, and yet all of those lessons have been lost.
Joseph, thank you very much for your time. It's been really interesting to hear from a different perspective, but some rather common themes, I fear. So, Well, thank you very much for having me this morning, Martin. It's been a pleasure. Okay.
Cheers.
Great, thank you.
Thank you.
So there you have it. Joseph's perspective from a different perspective, but actually the same themes coming through again. If you like this post, do add a comment, leave a question, and do check back next time for our next edition. I'm Martin North from Digital Finance Analytics. Many thanks for watching.